What is up, my trader and investing homies? It's your boy Kevin from Touchdown Trades, your trading BFF, your stock market bestie. Today we're going to be talking about 3 strategies, 3 simple ways you can make money in a falling and a crashing stock market. I've been seeing traders and investors all over social media, all over YouTube, freaking out over the market volatility that's hit over the last week or so. And I'm sitting here thinking to myself, what are these people doing? I love a volatile stock market. I love a stock market that's crashing because it's easier to make money in a falling market. I know that sounds crazy, but it is absolutely a fact. And today I'm going to be showing you guys my 3 favorite strategies to make money in a falling stock market. Sure, you're probably thinking to yourself, Kevin, you can just short the market. And yeah, this is true, but I don't recommend shorting the market to newer traders and investors. I do take some short trades and investments myself, but I'm typically a long bias trader for 2 simple reasons. Reason number 1, you have an overall edge if you're buying stocks versus shorting stocks because over time the stock market goes up. It's a fact. The stock market goes up over time at an average rate of like 7 or 8%. So if you're shorting stocks, you're already at a disadvantage. Reason number 2 is because you can get in big trouble trying to pick the top on a market that's just been going up. You could have tried to short the market here, here, or here over the last 4 months and you would have lost your. But if you just waited for a pullback and bought into stocks that you like long term, you would have made buku money. Alright, so let's get into today's video and talk about the 3 simplest ways you can make money from a crashing stock market. Let's get it. Alright, strategy number 1 is very simple. It's the most basic way of making money in the stock market in a falling market. And that is just don't panic. Do not panic. When the market starts to drop, don't panic. What we need to do is we need to have a list of stocks, 5 or 6 stocks that we like long term. Stocks that are trading at valuations that we're not willing to buy at that level. So we're waiting for that stock to drop. We're waiting for the market to crash and correct itself into a better price point, and then we strike. We have our ammo on the side, dry, and we're ready, waiting, stalking the market like an alligator swimming with his just head poking out of the water. And then when that stock hits that level that we're waiting for, we strike. We grab that stock, we swoop in, we buy it at that discounted price, and we add on the way down. One key point to this strategy is do not shoot your whole load. Get it? No pun intended there, I promise. But don't shoot your whole load at a falling stock and try to pick the bottom. If you like a stock long term and it starts to drop, take an entry position with maybe 1/4 of your desired position size. If it continues to drop, add a little bit lower, continues to drop, add lower. And then before you know it, you have a really good average cost basis. And when that stock starts to rally, you ended up getting a great deal on a stock that you want to own long term. What I will do is I'll make a list of 5 to 7 names that I really like, I really want to own, but they're just too expensive. For example, Tesla. I really wanted to buy Tesla when it was chaos and FOMO was going on. It was going up 10% every day, it seemed like, but I didn't. I didn't because I don't buy breakouts and I don't buy extensions, because if you do that over the long run, it will kill you. Sure, you may make money 1 or 2 times. You would have probably made money if you bought Tesla 3 weeks ago and had the insight to sell it right after the stock split. You would have made a ton of money. But if you do that over the long run, you'll lose money. So I put a price target that I wanted to buy Tesla, and I'm waiting for that price target to hit. And when it does, I'm going to buy it and I'm going to have a really nice price. So that's how you make money long term in the stock market, is not chasing stocks. You wait, you stalk your prey, and then you attack when the time is right. All right, so let's jump in to strategy number 2, which is going to be a little more complicated, but you guys are smart. You'll be able to grasp it. And this strategy is really, really good for making money, easy money, in a falling market. So this is basically a naked put strategy or a cash secured put strategy. You have a stock that you want to own. The market's falling, the stock's dropping, you want to own this stock at a discounted price. So let's use Tesla for example, and we'll just say Tesla's trading at $300 right now. But you don't want to pay $300 and you're not sure this is the bottom. Tesla's been selling off for days and days or weeks or whatever, and you're not sure Tesla's put in a bottom yet. It's still dropping. So what you can do is you can sell puts. So you could sell the $275 puts. Let's say you can sell them for $10 a contract for a month or two out. And then if Tesla does end up dropping below $275, you will own Tesla at that price. You will get 100 shares sent to you at the 275 level. You will keep the $10 per contract that you sold. So you're basically owning Tesla at 265 instead of 275. You're getting it at a discount. You wanted to buy Tesla anyways, and you're getting it at a $10 per share discount. So this is a really good strategy. If you want to buy a specific stock, you're not sure it's done dropping, so you want to get it at a little bit of a discount, then you can sell puts for that ticker. And if the stock ends up going above that put price, that strike price, before expiration or at the time of expiration, then you just keep the credit you took in and nothing happens. You won't end up owning the stock. But if the stock continues to drop and it's below that strike price at expiration, you will indeed own the stock, but you're getting it at a discount. And it's a stock you wanted to own anyways, so why wouldn't you do that? Right? Why would you buy it at the price it's trading at if you're not sure it's done dropping when you could just sell puts, keep the credit, and also have the opportunity to own the stock at a discounted price? All right, so strategy number 3 is going to roll into strategy number 2. They're very similar but different, kind of the opposite, but similar. I know it sounds crazy, but it's true. All right, so let's get right into it. Strategy number 3 is selling covered calls. What I like to do is I like to sell the puts, and then if I end up getting the shares put onto me, I end up owning the stock, what I will do is I'll start selling covered calls. So let's say I own 200 shares of Tesla at $300. Just to keep the example consistent throughout, I own 200 shares at Tesla at $300. I'm concerned the market's been really volatile. Tesla's been selling off, so I'm concerned it's going to continue dropping. What I can do is sell covered calls. I can sell 2 contracts because I own 200 shares, so I can only sell 2 contracts of covered calls on Tesla. Let's say I want to sell the 320 covered calls for a month out. Let's say I take in a $10 credit for each contract I sell. So I'm really getting a $10 discount on top of the discount I already got for selling the puts. My price point keeps dropping on Tesla every time I sell a call on the position that I already own. I'm getting $10 per contract. If Tesla ends up trading above the strike price at expiration, the buyer of the options contract will take my shares. They will now be the owner of my Tesla shares, and I will just keep the credit for the options that I sold. However, if Tesla ends up dropping and trading below the strike price at expiration, I will continue to own the Tesla shares and I will keep the credit that I gained from selling the options contracts. So it's a way to hedge against the market. It's a way to lower your average cost of whatever stock that you want to buy. And it's just a way to profit from a falling market. You're already owning stock that you wanted to own anyways. So why not take this standpoint that you're going to try to lower your average cost? You're going to get that cost basis down. And if it ends up your shares getting taken away by selling the calls, or you ended up getting exercised, that's fine. You get to keep the credit, no problem. The moral of the story is do not panic when the market starts to sell off. Have a plan in place. Have an idea of what you want to buy. What stocks do you want to own at a discount? And if you have that plan in place, you will not lose money in a falling market. Sure, your account may pull back some because you're not going to panic out of your position and sell all the stocks that you own just because the market starts to pick up in volatility, but that's fine. That's the way investing, that's the way trading works. That is okay. When you buy a stock, you should always have a plan. Know what price you want to buy that stock. Know what price you're going to sell that stock if things don't go your way, called a stop loss. And know what price you want to sell that stock. I hate to see investors and traders just buying stocks blindly and not knowing what their plan is. Where do they want to get out if things starts to go bad? Where do they want to sell? Optimally want to sell your position to take profit. Because I saw investors buying Tesla blindly and they didn't sell, they didn't take profit, and now they're stuck and they have no idea what they're doing. They're looking around the social media. What should I do with my Tesla stock? Should I sell it or should I keep it? It's just a bad sight to see. Always have a plan. I hope you guys got something from the video. If you did, go ahead and hit the like button for me. I love all of you guys. If you're new to the channel, go ahead and subscribe. I'll catch you guys in the next video. Peace.